Hey everyone, today on the final bar, we're joined by Joe Rabil from Rabil Stock Research coming back on the show. Joe's one of my favorite stock pickers, always does a great job bringing a couple of charts that I often wish I would have found on my own because he has a way of finding actionable charts that look compelling. Two good ones to share with us today. Overall, the market in appreciation mode with the FANG stocks leading the way higher. Netflix's earnings win yesterday really propelling that key mega cap group to the upside, taking the rest of the market with us. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a shady but warm and comfortable Redmond, Washington. Thanks for joining us every weekday after the close as we look at the markets through the lenses of technical analysis, behavioral finance, investor psychology, breadth, sentiment, price, all of those good things as a way of understanding, getting inside the head of the other investors out there and trying to understand where they are placing their bets, right? Where supply meets demand, where fear meets greed, and all those other things. The market. I was talking with Joe Rabil, my guest, before we started the show, and we're talking about how this, the market keeps going higher. And I certainly, if you've been watching the show, I've been talking about strong price, strong breadth, euphoric sentiment, and that in order is bullish and and contrarian bearish, basically, right? Strong price is good. Strong breadth is supportive, but strong sentiment, euphoric sentiment, excessive sentiment, I would argue is more of a bearish condition, suggesting that sort of the anecdotal last buyer has already made their trade. However, days like this, where the market keeps pushing higher, reminds me that price and breadth, or there's a reason why those are the more important ones. Follow the price until proven otherwise. Now, we're going to, again, talk to Joe Rabil from Rabil Stock Research here in a little bit. Tomorrow, on Thursday, we have Sam Burns from Mill Street Research joining the show. Next week, on Tuesday, we have Bruce Powers. Bruce is a fellow CMT. He spent much of his career in the Middle East in Dubai and really was there during the explosive growth of that region of the world. So it brings an interesting global perspective. He's now back in the United States. And then Wednesday, Julius DeKempener, founder of RRG Research, who graciously took a rain check when we lost power and couldn't get our show done last week, is going to be coming on the show and giving us a taste of sector rotation. So some great guests coming today and later this week and next on the final bar. Let's get to our market recap. As I mentioned, the market clearly in offense mode by most measures you can come up with. It's offense over defense. There are some notable exceptions to that rule overall, but certainly speaking to strength over weakness. The S&P closing above 3850, up from 3800 yesterday, so a nice uptick of about 1.4%. The Nasdaq really the strength, though, with the Nasdaq 100 up 2.3%, just below 13,300. The VIX back lower, below 22. It's around 2150. Looking at some other asset classes, we have bonds essentially flat, sort of chopped around and increased going into the end of the day, and 10-year yield is essentially flat from yesterday, below 1.1%. Oil prices came off after opening a little earlier. The USO closed essentially flat for the day, but precious metals stronger. And let's start there before we get to some of the other charts. When we're talking about the chart of gold, overall, my discussion and my thoughts have been long-term structurally. This is a bullish asset class. It's a bullish long-term chart. If you go back for a couple of years, you can see this pattern of appreciation and consolidation, and we've certainly been in one of those consolidation modes where gold has given back a lot of those previous gains. I think the biggest tell for me was when gold traded below the GLD here, traded below the 200-day moving average, rallied right back up to resistance. And the point here was we are really close to signaling a return to the previous highs, if not much, much further. This might be the end of that. of that corrective pattern. It failed though. It failed just right at that resistance level, and since then has retraced back to below its 200-day moving average. Today, that changes with the GLD bouncing back higher, with silver bouncing back higher. And so, it may be more of a choppy backing and filling type of pattern, more of a sideways, what we'd call a time correction, right? Remember, the markets can correct in one or two ways, or a combination of those. They can correct in price, meaning they pull back in the opposite direction, or they can correct in time, where it's just a period of time where they're more stagnant, more at an equilibrium point, more rotating around a certain level before the next move occurs, and potentially more it's more of a time correction at this point, and trading around in these levels before breaking out. It remains to be seen, but overall, certainly a nice bounce higher from gold and silver today. The chart of the S&P 500, I think, is a great reminder of the value of simple trend analysis tools like trend lines. If you take the low from the end of October, connect that to the low from the end of December, you can see that lines up pretty well from the low Friday into yesterday's session. We've now bounced back higher, with the S&P making a new high above 3850 here for the first time. But you can see this trend line for me certainly indicates a pretty decent track at this trend over the last month or so, of course, coming off of these October lows. And as long as we remain above that trend line, you have to assume that the trend is in place until proven otherwise. And so the first indication that this is no longer, that the subtrend may no longer be in play, is a break below that trend line. That's the very first thing I would be looking for. The second thing would be breaking below the most recent swing low, which means on that shortest term time frame, that tactical time frame, 3750 is the level I would be looking at, and seeing if we're able to hold that, or if we break below it and indicate a bit more distribution than we've seen historically. The RSI not quite overbought on the S&P 500, but getting back up to that overbought level again as stocks move on to reclaim yet another new high. Let's look at the sector rotation today. Communication services, number one. One of our 3 and 3 charts yesterday was Netflix. And if you missed it, we were recording right after the close when they came out with earnings, up about 10 to 12% in the after hours. It's continued to the upside with today's trading, closed about 17% above yesterday's close. So, that in my mind is the first of the FANG stocks, or the FANMAG stocks, if you will, to break out of this sort of consolidation phase. The FANG trade was exceptional in the bulk of 2020. It then became a sideways trend, sort of a market performer, as other groups like financials, energy, materials, industrials started to really emerge as leadership, and these mega cap tech and consumer names sort of held off a bit. Now we're starting to see a rotation back to the upside, with charts like this resolving to the upside. The question in my mind when it was going into earnings, as we talked about on the show yesterday, was, if we do get a bump, what do we do relative to this, this level of resistance, about 560 to 570. This is where we've peaked out 3 times. It's a triple top here from July through October. Are we able to eclipse that? Today, on a closing basis, we did in fact eclipse that high. And so the question, anytime you break through resistance or break down through support, you will always hear me say, and today I'll do the same, it's all about the follow through. Do we follow through tomorrow? Do we indicate that this was not just a one-time thing, that buyers are pushing this and taking an interest? There's an influx of demand that's going to push this to further highs. The rest of this week tells you if that's the case or not. If we fail, if we retrace tomorrow, we go back below 560 or something and really push back higher, which I don't see that necessarily happening, but it could. That might indicate this is a bit of a false breakout, and we don't have that follow through. So breakouts are the first step. The follow through, the confirmation, the validation of this breakout is what I would be looking for through the remainder of this week. But it is worth noting that the FANG trade, which I think a lot of people, including me, have written off now for a while, reasonably so, because the fact that they really haven't done anything, especially on a relative basis, this may be the beginning of where we're talking about the FANG trade yet again. It makes me think, what does that do for things like financials or elsewhere that may be in a different configuration? The financial sector down is the worst performing S&P sector today. This is coming off a fairly elevated level. The financial sector has done just fine. We continue to see a pattern of higher highs, higher lows. It's down less than 0.5%. So this wasn't a big distribution day by any means, but it's noteworthy that on a big up day, financials did not participate. They weren't a part of this. The rise in financials, the outperformance of these stocks is driven by higher rates, and essentially that steepening of the yield curve that speaks well for the larger banks, but especially for regional banks. And when you don't see that sort of move, you're going to see financials lag behind a little bit, and that's sort of what we saw today. So again, it is one day's worth of trading, but I think that is an emerging theme to be thinking about to see whether that's the beginning of something further. I think it's also worth noting, with communication services being the number one sector today, up about 3%. The number two sector is probably not one you would have guessed, given a strong update led by the FANG stocks. It's real estate, with the XLRA being the second of the 11, up over 2%. So again, I've often reminded people, do not for a moment think the market's doing X, which means these sectors should work and these sectors should not. Those are good guidelines. Those are good general ideas, ways to approach sector rotation, but I would focus much more on what the charts themselves are telling you. Focus on what actually is working and not what should be working or should not be working on at a given moment. Final thing, just to wrap up this market update, is the breakout in home builders. A lot of the home builders with a nice bounce higher. These are the 10 stocks with the biggest gains in their scooter rankings just today, and you'll see a number of the FANG stocks up here: Amazon, Alphabet, Netflix, obviously at the top. But you'll also notice home builders, DR Horton, Pulte Homes, Lennar, all in the top 10 groups. This is a group that has not necessarily been on a lot of people's radar, but just starting to break to a new swing high. The ITB testing a new 52-week high, so worth paying attention to if you've not been aware of that group in a while. We need to take a quick commercial break. Back with my guest, Joe Rabil from Rabil Stock Research. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's a pleasure every day to share charts with you and share this journey of navigating the market environment with you using the power of technical analysis. As a reminder, we are here as a resource for you as you go along your journey. If you have questions that come up as you review charts, as you hear things on social media, on financial television, whatever it is, drop us a line and let us know what we can answer for you. Shoot us an email, if you could, at thefinalbar@stockcharts.com. On our YouTube channel, just put a comment right below the video you're watching, or tag us in a Twitter comment at FinalBarSCTV. We'll gather all those questions that we're getting. We'll do another mailbag segment at the end of this week on Friday's show. I want to welcome on my guest joining us once again, Joe Rabil from Rabil Stock Research. I've enjoyed following Joe's work. And Joe, thanks for coming on the show. As I was thinking of you coming on, I selfishly always wish that I would have found these charts before you share them, because somewhere in your process there's the ability to find actionable charts, and for that, appreciate you coming on. Welcome back.
Thanks for having me, Dave. So for anyone that's watched any of my videos, like on your Daily 5, and I focus a lot on momentum, and I obviously on the scales below I've got MACD and ADX, and but I added in relative strength today. And specifically, I wanted to spend a little time talking about relative strength because I think it's an interesting thing. When you look at a stock like FCX and you look at its scooter ranking is like 99 right now. And I guess the point I wanted to make today was that not all relative strength rankings are the same, to me, are created the same. In other words, you can have a 99 or something in the 90s, and to me, it's already exploited. So the last time I was on your show was in the beginning of September, and we talked about this Freeport-McMoRan. It was in the mid-teens back then in early September. And if you look at what the relative strength was doing at that point, it was really an emerging relative strength stock. So it was a stock that was really making new relative strength highs, but it hadn't been exploited yet. And so what I thought, and believe me, I'm not trying to pat myself on the back or anything. I'm really just trying to point out that when a stock makes a move like this, and we have a decent amount of stocks out there that have been what I would consider to be exploited, and I'm not necessarily calling them sells from a bigger picture standpoint. I'm just saying that if I'm putting new money to work, this isn't probably not where I want to focus my efforts, because I think it's setting itself up for some type of a consolidation or correction over the next few months. Maybe it wants to make it up to 33 or 34 before that starts, but I think we're getting to the point where it's getting pretty late, at least in the intermediate term. And one of the things I noticed that is the 71 reading on the ADX. When you get anything above 65, you're getting pretty excessive, and the trend is probably getting a little overheated. There are other stocks like Deere or, a Square or something like that I think kind of fit in this same sort of camp, where they've done really well, made really nice moves, but I think you have to accept the fact that even if their relative strength number is really high, or they've been a really good stock, it's not necessarily where I want to necessarily put new money to work. So if we go to the next stock, we've got Community Health Systems. Now this brings up two different points for me. Number one, if you notice, look at so this also has great momentum characteristics. I mean, MACD is strong and confirming. The ADX is a very strong reading up at 45, really powerful breakout and confirmation. You can see the big base on the pattern, and it's really just getting going in my view. I mean, this stock was up at like 50 a few years back, several years back. So it's not, to me, this is something that really could keep going. But the thing I wanted to really focus in on was the relative to the S&P. Look at what the relative strength line is doing. To me, this is like the start of something, as opposed to something that's really been moving for 6 months or 3 to 6 months. It's really kind of the beginning of a move, and I think you're just better served trying to identify new relative strength or emerging relative strength closer to support, and try and identify these type of names, because I think you're going to see. To me, it's a much better risk-reward scenario.
It's a fantastic chart, that second one, and both of these are fantastic, Joe, but it reminds me the value of looking at the ADX line. When you look at Freeport-McMoRan, you can see the established trend, something that's, it's gone vertical in some ways, gone maybe parabolic to the upside, but you can see how the ADX line increasing shows you the strengthening trend, whereas, Community Health Systems, a little less established at this point, but starting more of an emerging trend, right?
Yeah, exactly. And, you're not going to always find that, but over the last 3 months, I would say at least over the last 3 months, there's been an incredible amount of base breakouts like this, and they're still out there. But the second point I wanted to make about Community Health is that it's a $1 billion market cap. And, to me, it's pretty clear based on the move the Russell had. And believe me, I think in the near term, that the Russell ought to consolidate or pull back or take a breather or something. But because it has made a really dynamic move and it's pretty overbought. But at the same time, a lot of these breakouts coming out of bases are coming from like the $1 to $5 billion market cap area. And I just find it interesting that as long as we're seeing that type of pattern, I think the Russell's probably going to continue to trade pretty well, generally speaking.
It's a great observation. And I think you're right, that whole SMID cap trade, that the small caps, the mid caps especially, I was reading something recently about how so many are focusing on small versus large. And don't forget, mid caps are a ripe space where there are growing companies that are actually starting to emerge in pretty good shape here. This is fantastic, Joe. Thanks so much for coming back on the show. 2 great charts, and appreciate you talking through a bit of your process as well.
Absolutely, enjoyed it.
That's Joe Rabil from Rabil Stock Research. I love having guys like Joe on the show that I think of as really talented stock pickers, because every time they come, as I mentioned, as I was introducing, I selfishly wish I would have found these charts before he came on there, but it speaks to how he and others are able to identify emerging trends. And I think that comparing chart A to chart B would be a really good exercise. I know many of us hopefully own stocks that look a lot like Freeport-McMoRan, things that have done well, things that have performed well. And now the question is, what do you do with them? And I think thinking of your risk assessment, thinking of trailing stops and how you're approaching them would be really valuable right about now when the stock's still going higher. But then looking for emerging trends, that's where you hopefully are able to allocate new money. That's where you would focus on opportunistic, emerging trends as opposed to more established and potentially later stage breakouts. All right, our next segment is called ETFs Engage. I asked our producer Gretchen if we could hit this segment because there's an article in Barron's over the weekend that focused on biotech ETFs, and I thought it'd be really interesting to review that article, but really from a technical perspective, from a visual perspective. I often think with a show like this, hopefully we can provide the visual aids that an article like that hopefully should have included, but let's give it a shot. So, the point of the article, if you missed it over the weekend, it was called Want to Use ETFs to Play Biotech, Choose Carefully. And it's, a common exercise to look at something like home builders or, China or biotechs or semiconductors, and remembering that when you have choices on ETFs, there are different performance characteristics, different return profiles that will emerge based mainly on things like, how they're weighted, how they're constructed. So are they equal weighted ETFs or are they cap weighted, meaning the larger companies have an outsized weight, or an equal weighted one, which means the smaller mid cap companies are going to have more of an impact. Are they concentrated on a small number of stocks? Do they only hold 10 to 15 stocks, or do they own 150 names? And that's going to impact how the things do. And in the short term, they're all going to be very similar, but over the long term, the return differences can really become exaggerated. And so, if you think, boy, I like the idea of biotechs, and you just blindly buy something like the XBI or the IBB, which are certainly the two most well-known and most liquid ETFs in the space, you're limiting yourself in terms of your return capabilities, but also you're not, you're getting some exposures you may or may not be aware of. So it's certainly a let the buyer beware sort of mentality. Having said that, let's look at the biotech index. $BTK on StockCharts is our biotech index. This is pretty standard way to view the space. And as you can see, the BTK is really made a new 52-week high actually today as I'm looking at it, but really close to a new closing high. I don't know if it's quite done it or not, but really close at or near those highs. And the question for me when something reapproaches resistance is, does it have enough juice to push to new highs? And that's when you approach resistance, that's good. Step 2 is you break above resistance. Step 3 is confirmation or validating that breakout. That's what we talked about on the chart of Netflix a little earlier in the show today, about looking for confirmation after a breakout. That's what I'd be looking for as something like the BTK approaches its new highs. So if you look at the relative strength of biotechs versus the S&P, you can see a period of underperformance in July and August, a period of essentially sideways performance that we're pretty much still in the middle of here. We haven't made a new relative high in a number of months, really since back here in early November. So what you'd be looking for is a rotation to a new relative high. So while a new price high would certainly be encouraging, a new relative high and showing that it's able to continue outperforming other stocks would be good. Because if you start the clock the second week in December, overall you've done pretty well owning this index versus other versus a passive benchmark. So the question is it able to sustain those? Now, when you look at some of the particular ETFs that are in the space, you can see that the return profiles are a little different. This is the XBI, the biotech index. This is our biotech ETF. The IBB is another one, but then there's some others that you may be less familiar with: ARKG, IDNA, GNOM, and you love some of these ETF tickers. They're fantastic. BBC. These are the most common ones. If you're not very familiar with what these ETFs are, there's a trick down here below the chart on the sharp charts. Click from the legend drop down, switch to verbose. That just gives you the spells out the name of all these. This is the biotechnology index. The relative, here's the Spider Biotech ETF, the iShares Biotech ETF, the ARC Genomic Revolution Multi-Sector ETF, and you can see the names. These are all ones that have genomics as in part of the name. And then the Virtus LifeSci Biotech Clinical Trials ETF was the last one. As you can see, they all have a similar price pattern where they're breaking to new highs. You can see higher highs and higher lows as they continue to move higher. So why are the returns in these all making new highs while the index is not? And I think a big part of that is because these all have exposure to the smaller stocks, things like PACB, Twist Biosciences, MCRB. These are all stocks in the small cap space that have done very, very well and have outperformed very nicely. And that's what's allowing these biotechs to perform a little better than the broader index. The next chart I want to show you, though, gives you the relative performance. It's this one right here. So I don't have these very well labeled, so sorry for that. But if you look at the upper left corner, you can see it's color coded and it tells you the tickers here. And I'll try to make the chart a little bit bigger so you can see the tickers in there if you missed it. And so as you're looking at this, it shows you how just year to date, the returns have actually been very different. So the number one performer, up 17.5%, is ARKG. That's the ARKG. That's the Biosciences ETF. The worst performer is still up 4%. It's this one down the bottom. This is the biotech index, actually. So the worst performing biotech ETF is the IBB here in red. The next one is the XBI here in blue. So the two most common, two most liquid biotech ETFs are also the two worst performing biotech ETFs if you look back just the first couple weeks of this new year. Now, if you go back even further, and if you look at the last 1 year, for example, you can see that the return profiles are dramatically different because ARKG has outperformed the rest of them by far. It looks like Bitcoin versus everything else. If you're looking at cryptos versus non-crypto asset classes, because the returns are so much better. And again, it's because it has a much higher weighting. It's weighted much bigger on some of those small cap names that are riskier, but have had much stronger return profiles. So over time, even just year to date, in 2 weeks, you've seen that the returns are very different. 17% positive down to 6% positive, depending on which ETF that you get. But even over the longer term, you can see that the return differences become much more exaggerated because some of these stocks have had much bigger runs over the longer term, over the course of the year, and that's what's allowing some of these other ETFs to outperform. So as a reminder, as always, when you're looking at an ETF, I would encourage you to look under the hood and understand what sectors you're being weighted into, what individual stocks you're getting exposure to, what sort of exposure you have and what weightings they have, how concentrated the ETF is as well. And very quickly, just to wrap up the segment on the biotech ETFs, these are the stocks that are causing them to do so well. This is PACB, Pacific Biosciences of California. It's one of the top ranked small cap stocks in our small cap scooter universe. You can see that the relative performance is incredibly positive. Most of that's come in the last 4 to 6 months. As you can see, this uptrend has accelerated. It's a single digit stock that's now in the low upper 30s. That'll certainly cause an ETF to do just fine. Twist Biosciences we've talked about before because it's been one of the top mid-ranked stocks. It's actually the top ranked mid-ranked stock at the moment, or number one or number two. It has been, and then MCRB is the other one that's weighted in some of those ETFs. It really gapped up in August, and that's what caused the bulk of the outperformance, but still has outperformed the most benchmarks handily. So as a reminder, those are some of the biotech ETFs, and I would just encourage you to look deeper than the one you know. A lot of people just do the IBB because that's the one that you know. Remember, there are other opportunities in there. There are other levers that you could certainly pull. We need to wrap the show. Go to the 3 and 3 charts. 3 minutes. Here we go. Chart number one is our S&P market trend model. We usually look at this on Fridays when we do our weekly wrap show. We didn't get to review this as much over the last week, and I just want to point out the value of having a long-term trend following process. For me, models are not an output of my process. I don't build anything or trade anything based purely on a model. I like to run models in the background and have them be an input in my process. I like to see the results of the model and incorporate it along with other tools, other information and analytics that I can bring to bear. But it's worth noting that the long-term trend has been positive. The medium-term trend has been positive. What's interesting to me is that the short-term trend has been remaining positive as well. For me, it's based off of the closing price every week relative to the 5-week exponential moving average. And as long as we are remaining above there, the trend overall is positive by definition. And it has reminded me to stay in this trade. As I've talked about euphoric sentiment, as I've been thinking we are ripe for a pullback, we haven't had it yet. And first things first, we have to break down and close below that 5-week exponential moving average on a weekly closing basis. I will let you know when it happens. It has not happened yet. Chart number 2 is a daily chart of the S&P 500, and this bottom panel is the percent of S&P stocks above their 50-day moving averages. And what I want to point out here is the fact that we're actually down lower. This is not updated yet for today. I would expect this to bounce up a little bit, but going into yesterday's session, after yesterday's session, we came up a little bit, but there was a decrease in the number of stocks above their 50-day moving average. This is the beginning of a bit of what you might call a breadth divergence. Still very early on, and I would be very interested to see if the market rallies with this line going downward overall. That would be a divergence that could be the beginning of a cause for concern, but not there yet. Finally is the home builders chart, ITB. As a reminder, that's one of the home builder ETFs, more of a pure play on stocks like D.R. Horton, Pulte Homes, Lennar, and others. Just making a new 52-week high, making a new 52-week closing high today. As with many of the charts we've talked about, I'm curious if it'll be able to follow through. Folks, that is our show for today. Thanks so much to Joe Rabil from Rabil Stock Research sharing his thoughts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.